Hey, Shalom, Yahweh Shem Yahshua Barakatah. Okay, double honors to the apostles of GMS and honors you brothers have been pushing this truth and sincerity throughout the four corners of the earth. Alright, it's going to be a relatively quick video regarding the financial markets. And, I'm going to go into a few bits and pieces. This was posted, was it 2 days ago? Okay, not too long ago. Okay, so, no, yesterday in fact. It says here the 30th of November 2016, so yesterday it was posted, and it's dealing with the impending market crash that brothers have been talking about for the longest. And I'm just going to go into the article, defining a few things, and so you can see the magnitude of what's going on out here, and pretty much how that Esau's market, he's deliberately crashing it. So all of these people out here that have got certain benefits by way of the job, and they've taken out certain amounts of debt on the promise of paying back that amount of debt. Okay, all of these people that have basically become dependent on the government, and the government, how they set up the system and so on and so forth, they're gonna bug out when this thing happens, and they're gonna have to present a solution. And as we have always said, that solution is gonna be the mark of the beast, man, which is the RFID chip, which is being issued out there in certain different countries as a technological advancement. But really, the elders have been pushing this for the longest time, man. Okay, so it says index market fell 2.8 trillion over the past 2 months. All right, now when you watch the video, this woman's basically saying, that's the first time. It says, that's the first thing. This is a crazy jump. Okay, but first and foremost, we need to define some things. So we got the index market, and we're saying it's fallen by 2.8 trillion over the past 2 months. And let's see what these indices or this index is, or what an index is. So this is a pretty good definition, financial definition website. They really go in on certain every time I use this, it steps you up onto a certain level. Okay, and I recommend that when brothers are reading these articles, because when you see 2.8 trillion, 1.8, 2.8 trillion, a loss of 1.7 trillion, you don't know if that's a big thing or a small thing. Okay, so you have to go into the definitions of these words, of which this goes to show you a lot of these things that they push out here, the important information, because this is on Bloomberg, man. This important stuff, this is going to go over Jake's head, man. Okay, there's no basketballs here, no footballs, things that Jake understands or anything like that. The first statement here, indexes. Well, Jake ain't gonna know what index is in the first damn place. Okay, but pretty much when you watch this, she's letting you know that the economy is pretty bad, and the presenters asked her to predict how December is gonna be, and she was trying to make it seem as nice as physically possible, but you can see it within her eyes that she knows that this thing is about to go down, man. Okay, all right. So indexes. Start off over here. It says, what is an index? Index or indices, okay, which is the plural form. An index is an indicator or measure of something, and in finance, it is typically refers to a statistical measure of change in a security market. Okay, in the case of financial markets, stocks and bond markets, indices, all right, which we're dealing with bond markets, so it might be good to go back a step to go forward. Okay, so it says, what is the bond market, which is what we're dealing with here. Okay, the bond market, also called the debt market, which is important, or the credit market, which is that's important because people see it is masked as something positive. Okay, credit is something positive, debt is something negative, but they call it the credit market. Hence, you have a credit card. Okay, it's a financial system in which the participants are provided with the issuance and trading of debt securities. Okay, we'll pause again and go into debt securities. I pretty much know what it is, but not to speak off the top of my head, but to go in, to home in on these different points. Okay, it says, what is debt security? A debt security refers to a debt instrument, such as a government bond, corporate bond, certificate of deposit, okay, municipal bond, or preferred stock that can be bought or sold from two parties and has basic terms defined. So when you talk about government spending, okay, a government bond or something like that, that's the government borrowing money, getting into debt. That's why you have what's known as governments getting into debt and defaulting. Okay, and what's happening is because the system is based on debt and debt securities. Okay, hence government bonds and corporate bonds and so on and so forth. You have a situation where the principal funds borrowed will never be met. So you're in a constant cycle of paying off debt that you never pay off. All right, that's why you have what's known as a mortgage, which is another form of debt securities. Okay, all right, which is what you have what's known as a mortgage, which is known as a debt note, because you're never going to be able to pay that back. Now, hey, you got some certain situations where people pay that off. Okay, but that's actually, as the more we get into the eye of the storm of this financial market, the more people should be realizing, really, look, you're buying some BS house. Okay, because you got five different families and all directions you turn is a different family there. So what you're buying is actually BS. Okay, if you're lucky, you get 12 by 12 out here in England. Okay, and that's gonna set you back up a lot. All right, you can take 10% of all of that you're just spending on the house and live like a bloody king out there somewhere in them islands or some shit like that. But that's another different story totally for another day. Okay, but what people are gonna be realizing now is the fact that this whole debt system is BS, man. Okay, and they put you in debt so you never get out of debt. Ultimately, that's so you become a slave to debt. All right, and ultimately become a slave to the elite banking families, and they're gonna manifest that debt you're holding by issuing out the chip, man. Okay, so it says such as natural. So it says I'm gonna finish off this and says, and that can be sold, that can be bought or sold between two parties, and has basic terms defined such as a notational amount, the amount borrowed, the interest rate, and the maturity and renewal date. Okay, so there's a little bits in there that's pretty juicy, and we may be referring to this in a second. So back to the bond market. Okay, it says the bond market, also known as the debt market. I'm gonna call it the debt market because that's what it is. It's a financial market in which participants are provided with the issuance and trading of debt securities. Okay, so they say securities there again. That's ESOL right there, because a security is something that's secure. Debt is not secure, or suppose it is in the fact that someone's going to ultimately have to pay it back. Okay, but they're trading in the negative. Okay, so someone borrows money. Okay, that's to set up a business and so on and so forth. That amount of money, let's say it's 3 million. That's 3 million negative to set up that business. But someone's going to sell that negative to another person in the hope that when the business owner pays the money back and the interest, both parties make a profit. So the person that sold the debt, so the debt might be £3 million in principle, okay, and then the first person sells that for 3.5 million, okay, with the fourth person hoping to make 4 million due to interest rates. Okay, so that's how the financial markets, in terms of the bond market, pretty much works, man. People are trying to make money off of the interest that you get from the principal that you borrow. Okay, it says the bond market primarily includes government issued securities and corporate debt securities. Okay, facilitating the transfer of capital from the saver to the issuer or the organization requiring the capital, right, for government, right, projects, businesses, and expansion. So basically the same thing that I just said, man. Okay, basically the same thing I just said. Okay, you got a situation where people borrow out money to set up businesses or for the government to do some roadworks or whatever. Okay, and then you have what's known as debt spending. But ultimately, we have also is a situation where that you're banking on making a profit, and that profit is only based on euphoria. In other words, people believing that what you're selling is of worth of value. For instance, the crash in 2008, you had a euphoria about them houses, but when people said, look, actually I don't want a house, the value of them houses went down, and ultimately the value of the securities, the debt securities went down. Okay, and then you had a market crash. So this whole system is based on belief, man. All right, it's the whole financial system is based on people believing that what they're buying is of the value that they're buying it for. Okay, and they're gonna make a return on that. So they get into debt with the hope of making a return off of that. Okay, so let's go back onto the index. Okay, so the index is an indicator or a measure of something in finance, typically that refers to a statistical measure of change in securities. And it says in the case of financial markets, stocks and bonds, indices consist of imaginary portfolios of securities representing a particular market or a portion of it. Right, and in reference to mortgages, it refers to the benchmark interest created by a third party. Okay, so that's pretty much. I'm going to read over that over this one. Okay, you get the vast majority of what's saying it. I'm just going to read this bit though. However, I was planning to read that bit. So it says breaking down indexes. All right, breaking down the indices. Okay, it says each index related to the stock and the bond market has its own calculation method. Okay, it says in most cases, all right, the relative change of an index is more important than the actual numeric value representing the index. Okay, and it's going to give us an example here. So it says, for example, the Financial Times Stock Exchange, the FTSE 100, is at six. If it's at 6,000, it says the number tells the investors that it's seven times its base value. Okay, and it says, however, to assess how indices change from the previous days, investors look at the amount it has fallen or risen. Okay, often expresses as a percentage. So if we round everything up, okay, you got these indicators, okay, all right, how much money people are making back, all right, in terms of bonds. Okay, so someone borrows out a certain amount of debt, all right, and you have these indices which are the indicator on how much money is being made back off of that debt. Okay, hence you have a global bond market. All right, so let's go run through that again, because that might be hard to digest the first time around. So you have a bond market, which is a debt system. Okay, you issue out debt in the hope of making money on the debt, whether you're selling the debt, hence the word bond market, or whether you're sitting on the debt and you have the person pay it back to you. Okay, and then you have an indicator on how that bond market does. Okay, so you got a debt system, which is the market, and the indicator to that debt system is indices, of which in particular the FTSE 100. Okay, and that lets an investor know, and an investor is a person that's going to buy the debt off of someone. Okay, that's an investor. You can buy that debt off of them. Okay, all right. You have an investor that's going to buy that with the hope that they're going to make money back on it. Okay, yeah, which they're going to go into that. I'm not going to read it now. You can read it for yourself. But they do it with the hope of making money off of it. Okay, and the FTSE 100, which is an indicator on how much or how good the amount of money you're getting back. Okay, how good the security, quote unquote, is. Okay, is the FTSE 100 is going to be an indicator to that. Okay, so when they're saying here the global suffers a 1.7 trillion loss, what they're basically saying there is the whole global market, the amount of money that was making off of that, the value of it has dropped 1.7 trillion, which is a big figure, man. Okay, if they say that Rothschilds is worth 18 trillion or something like that, 1.7 trillion is a lot. In fact, you can't count to that. Okay, that's a difficult number to count to. Okay, so let's carry on. Okay, it says the index market fell 2.8 trillion over the past 2 months. Hopefully I'm breaking this down correctly. If not, obviously leave your comments, and that will help me in edifying me, and that will be good. Okay, so it says a 30-year-old bull market, right, in the bond markets looks to be ending with a bang. It says the Bloomberg. So we could look at this as well, because that's going to be of interest. So like I said, this is a good website to go to for defining certain things, man. Okay, it's good to go to. As the elders say, look, this stuff is out there, man. You could go and check it out for yourself. So this is what a bull market is. I have a rough idea of what it was from what I read a long time ago, but we're gonna go into it. So it says a bull market is a financial market or group of securities or debt, as we've seen here, or group of securities in which prices are rising, okay, or expected to rise. So when they're saying here that 30-year-old bull market in bonds looks to be ending, they're basically saying you had 30 years of gains. Okay, people were making money by way of euphoria because they were believing what they was buying was going to increase in time. Okay, all right. They was buying all of that debt, these different debt, the financial stock markets and so on and so forth. They was buying those packaged, bonds. Okay, and they was hoping to make money off it. And for the last 30 years, they were. Okay, but they're saying here now it's looking to end with a bang. Okay, because people are realizing, hold on a minute, actually, I'm going to stay at home with my parents because this house price is just too much, and they do that. But in so doing, that has a knock-on effect in that people, the house value, because it's not so desired, is going to go down. So the amount of money you get back on that is less. Okay, just to give you an example, it says the Bloomberg Global Aggregate Total Return Index lost 4% in November. It says the deepest slump since the gauges rather more inception in 1990. So since this thing was incepted in 1990, it's never fell such a steep percentage. It says Treasuries has extended declines. It says Thursday OPEC's agreement to cut oil production added to the prospect of high inflation. That's important, okay, because that's when people prices of food and all of that's going to go up, and that's when you really get a slump, because what keeps the market driving is people having disposable income, okay. But when you have less disposable income, that's what is circling the drain, okay. So it says the reflection, the reflation, right, trade has been driving markets since Donald Trump's election victory due to his promises to for tax cuts and $1 trillion in infrastructure spending. All this has promoted, of which that $1 trillion in spending, you better believe that's going to be in the form of a bond. Okay, so his promise to save America is to destroy America. Okay, you gotta know how this system works for you to really understand that the ultimate thing for this is gonna be a crash, man. Okay, that's why it's predictable. That's why you can mathematically map out when a country's debt, when it reaches that debt, well, they have a debt ceiling which is persistently rising. There comes a point where you can't raise the amount of debt you've borrowed, so you have to default. Then you have what was happening out there in Venezuela, what's happening out there in Zimbabwe, and Italy, Greece, and so on and so forth, man. Okay, and it says all this has promoted investors to dump debt that was offering yields at record lows. All right, at near record lows. So let's break down what's being said there. So it's saying the investors, the people that was buying these debt, or by way, or some way or shape or form, they say Chinese investors or something, they were buying all of these bonds. The government spending infrastructures, they invested in all of those different things. But now they're dumping that because the yields, as we're going to see here, yields is the return that you get on that debt. Okay, those yields, right, were declining, man. The money they were making back on that was lowering. So it says, what is a bond yield? A bond yield is the amount of return an investor realizes on a bond, on debt, as we have seen. Okay, so we can close that down because they'll go into it and all of that. You can do that yourself. In the interest of time, I'm not going to do that this time. Okay, I already had that prepared too. Okay, so let's go back to this now. All right, so they're not making that much money off of it, so they've just been getting rid of it. It says Corlin entered a 3-decade bond bull market. A bull market, basically, like we've said before, is money that was making back of it was going up, so people were just investing because you think it's gonna go up. But that's just euphoria. Euphoria always ends, man. Okay. So it says it's no longer looking like a fool's errand. It says the Federal Reserve is expected to raise interest rates again, and so more often than once a year, inflationary expectations are climbing, and there's hints the global central banks may buy less sovereign debt going forward, which is that's going to be a damn crazy thing there, because them countries that are in sovereign debt, they ain't gonna have no bailouts anymore. Okay, so you're gonna have impoverishment on a scale that people have never seen before, because they got accustomed to a certain lifestyle that pretty much nobody could afford. Okay, it says investors pulled 10.7 billion from U.S. Bond funds in 2 weeks after Trump's victory. It says the biggest exodus since 2013's taper tantrum. Okay, while American stock indexes jumped to records. It says the markets has moved in with remarkable swiftness to price in anticipation of reflationary impact of Trump's administration. Okay, so it says November wiped a record 1.7 from the global indices in a month. Okay, and so the world equity markets capitalized climbs 635 billion. So pretty much, man, they're letting you know that this financial market is done. You can check out the rest of the article for yourself. Hopefully I did half a decent job in doing that. It's not the easiest thing to do. Like Henry Ford said, if we really understood how this market worked, you're going uprise, man, because it's all BS. Okay, so with that, I'm going to say all praise unto Yahweh by Shimmy outside. Double honesty, apostles of GMS. And all she brothers will be pushing this truth in sincerity. Shalom.